Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There are a lot of people that now expect, because of that posturing from Israel, it's hard to back up from that, and Israel will strike in some way. So when you ask, what impact could this have on the global economy? Well, Iran is a major oil producer, and anything that raises anxiety about the flow of oil in that region could contribute significantly to concerns about shipping.
Tesla is better looked at through the lens of the patients stabilized. So, we're not seeing the reductions, as you pointed out, that we saw, earlier in the year. And there are some key catalysts that are coming up. One is robotaxi. Two, the one that we're really focused on is on the energy business, getting Shanghai built where they can double the capacity and really start delivering more of these mega packs.
If you look at revenue down 10%, earnings down more than 25%, really highlight some of the pressures in the business currently. You see Nike taking proactive actions to reduce classics footwear inventory in the marketplace. That's had a significant hit. And then frankly, you've seen lower than expected unit demand in a couple of places. The company called out back to school in North America, as well as the retail conditions in China, both as some incremental challenges. So maybe no surprise that you see the reaction from the stock today.
We got 1 hour to go until the market close. So let's take a look at the major averages right now. I'm kind of searching for direction here, bouncing between gains and losses. The Dow up 55 points at the moment. That's about 0.1%. The S&P 500, very little changed here. Oh, not going to it, but there you go. You got 5,700 or so, 5,710 on the S&P 500, and the Nasdaq up about 0.1%. We did have some economic data today. ADP private payrolls showing a gain of 143,000 last month. August's gain was the smallest going back to March of 2023. So this representing a recovery here, and it's better than estimated. This can presage, of course, the Friday BLS jobs report. It doesn't always, but usually directionally, we see it go in the same direction. The estimate for non-farm payrolls on Friday is 150,000. So we will be watching it very closely here, really to figure out the state of the labor market and to try to extrapolate what the Fed is going to do next. So you've got that going on as a backdrop for markets. You continue to have concerns over rising tensions in the Mideast and perhaps awaiting some kind of retaliation from Israel to Iran after Iran's attempted strikes on Israel yesterday. All of that amidst a backdrop of the port strike, which is happening as well. So Josh, a lot going on both on the economic and geopolitical fronts.
Thank you, Julie. Well, for more on what's ahead for the markets, let's now welcome in Eric Hirsch, Hamilton Lane Co-Chief Executive Officer. Eric, it is good to see you. As Julie was just saying there, a lot of powerful cross currents, Eric. We have these rising geopolitical tensions, historic port strike. Of course, you also have China stimulus to consider. What are you looking at here, Eric? What are you trying to stay focused on?
Well, Josh, nice to see you. Nice to be back. I think we're looking at all of those things. I mean, none of that is painting a particularly attractive picture right now. But I think this is different in terms of what has happened and where are we versus where we might be. So in terms of where we sit today, economy looks very strong. The job number's a little soft, but we're also seeing layoffs very soft as well. And so we're seeing a resilient consumer. We're seeing strong spending. We're seeing continued positive outlook for the CEOs of our businesses. So that's where we are today. The picture you're painting, though, is very uncertain about what tomorrow may look like. And so certainly what's happening in the Middle East and what's happening with the ports, all of that is a bit concerning.
And so when you talk to your CEOs, when you hear from your CEOs, are they more cautious on spending decisions, for example? I mean, we also, of course, have the outcome of the presidential and congressional elections here in the U.S. So are we seeing a waiting game being played at all to make some big investment decisions?
Julie, I think it's a question of what sector are they in and what kind of a time horizon are they on. So there's no question that on some levels, we're seeing people simply deferring a decision or saying, you know what, ask me in 2 months. Hopefully the election is settled at that point, a little bit more transparency on where developments are occurring in the Middle East. And so in that case, if they have the luxury to do that, then that's what they're doing. In other cases, they're still seeing strong spending and strong demand for their products. And so it is still pedal to the metal and they're not slowing down.
So you sound overall like relatively constructive on the American economy, Eric, which is what Jay Powell sounds like too. What would be on your list of worries for the economy, not just near term, but intermediate term here as well?
Well, I think an unsettled election, I think, certainly weighs on us. I mean, if you come out of this with an electoral college tie or a question of how long are we waiting for results, I think all of that could create some real uncertainty in the market and also in our society. So we're certainly keeping a close eye on sort of how the election is proceeding. And again, what's happening in the Middle East with escalations, I think, is also very concerning, whether that's going to impact oil pricing or whether there is a contagion effect on a military basis. I think that is also something that we're keeping a close eye on.
What do you think is going to happen? We're talking mostly about sort of internal investments in the business. I'm curious also what's happening with deal flow outside of these businesses. In other words, are we going to finally see the much awaited pickup in things like IPOs or M&A for that matter?
So this is a question of, I think, where you sit. So today at Hamilton Lane, our deal flow is literally at record levels. We have an abundance of capital, a tremendous global reach, and deal flow has been our friend. So for us, we're sitting in a very enviable spot at that point. Now, as I look into 2025, I do think we're going to see an uptick of IPOs. I think one of the reasons why the market remains a little chilly today is really around the election and people not wanting to price or getting into a roadshow right in the midst of an election season. And so better to probably wait. And then again, if we wait, now we're in the holiday season. So I would expect that the first quarter of 2025, you're going to see a lot more volume on both the IPO side and the M&A side. The big caveat, though, is back to what we're talking about. This presumes that the port impact is sort of short-lived, which I think it will be, and that we don't see massive spillover in the Middle East, which I don't think we will see.
What kind of concerns, if any, are you hearing, Eric, when you talk to clients about the regulatory backdrop in this country and their expectations that it could be changing?
Yeah, I think this is an issue of how broad reaching. So if we wake up tomorrow, I think as we sort of see the polling, I think we see a far more likely outcome today of sort of a split government. And in a split government, the market's probably going to be happier with that outcome. That will sort of cool sort of any major regulatory changes. And so that's probably what we're expecting today as we look at the polling numbers.
Eric, finally, I want to ask you something about your business and your industry generally, which is there has been more talk about sort of opening up private equity more to individual investors to get access in various ways. I know you spoke to an industry publication recently about this. How open do you think it's going to be? How accessible do you think it's going to be? And will that be a good thing if we see that kind of change?
Well, I think it's going to be a significant change. I think to the publication, I sort of referenced it as a seismic change. And I think that's exactly what's happening here. If you look across, we'll just focus on the US for this conversation. Look across the US population, the number of millionaires is growing substantially. The number of people with $1 million or more of investable net worth continues to compound at a very, very high level. To date, the vast, vast majority of those folks have been totally precluded from participating in the private markets. And so their access to investments has really just been traditional, publicly available investment opportunities. Now, they've been jealous of the institutional investor who has had the benefit of private market exposure. They've seen the benefits of diversification. They've seen the benefits of some lagging correlation. And they've most importantly seen the benefit of significant outperformance, and they want that. And now for the first time, they're being able to access that, and the multitude of choices that are being made available to them is very significant. So the flow of capital is just starting. It's going to continue for a long time. I keep saying this is a marathon, not a sprint. That is exactly how we at Hamilton Lane are approaching it. But it's going to change the industry. It's going to mean more capital flowing in. That's not necessarily a bad thing. But it's also a very different consumer to service. Our industry has really been built on exclusively servicing the institutional investor. And so now moving into serving that sort of individual investor who's going to have different technology wants and desires and different pacing desires and different levels of transparency. all of that is going to have some real impact on our industry. In general, I think it's all going to be a very positive impact. I think it's going to frankly pull our industry more into the modern era, and I think that's a good thing.
Yeah, it's really fascinating, and of course, we'll keep in touch with you about it as it goes on. Eric, thank you so much.
My pleasure. Thank you.
Well, OpenAI has closed a massive funding round that values Sam Altman's generative AI giant at $157 billion. For more on this, let's welcome in Yahoo Finance's Dan Howley. Dan, there's been a lot of reporting recently that this was in the works. So now it is closed amidst a time of some turmoil for the company as well. So give us the big picture here.
Yeah, they raised $6.6 billion. Some of the investments come from the likes of Microsoft, a little bit of investment from NVIDIA, which is interesting, and then a number of VC firms. But as you kind of pointed to, this is a time where OpenAI is dealing with a number of high-level departures. Their CTO just left. Some of their scientists have left. Co-founders have left. So this is a time where you're looking at this company and you're saying, okay, so it's basically Sam Altman's company. Microsoft has obviously a kind of, you would think, guiding hand to a degree, just based on the huge sums that they've invested in it. I think part of the equation comes down to, how does Microsoft feel about the changes going on there? But I guess that's besides the point when it comes to this round, because clearly they still have plenty of people who believe that they have room to grow and will continue to be a driving force in generative AI. That's despite the fact that the likes of Google, Amazon, Apple, kind of to a degree, Meta, are really building up their own AI offerings and proving that they have what it takes to compete in the space as well.
So it was interesting, Dan. I saw reports that they're actually on track to lose around $5 billion this year on something like $3.7 billion of revenue. But I guess these investors are just saying, that's okay. Spend, grow, take as much share as possible. We'll worry about the bottom line sometime later.
I mean, that was the kind of go-to idea for Silicon Valley for a while, right? Mostly prior to the pandemic. That was the kind of go-to model, was just expand, burn our money like it's nothing, and then you'll get us on the back end, basically. And for a company like this, expenses are kind of different from what we saw from the Facebooks or Metas, whatever. It's Facebook then, so let's just call it that. Because they have to invest so heavily in the hardware, the land, to have data centers. I mean, it's not just building software and paying people. It's huge sums of money going into the actual infrastructure to operate the business itself. So they're going to continue to burn holes in the pockets of their investors until they're able to start turning a profit based on either deals or signing up more enterprise customers or getting consumers to sign up for the pro level. And there are obviously subscribers that do use the pro level. They still have millions of users who use the free version, but it's going to be the enterprise and those deals that they sign, something similar to what they have with Microsoft, Apple, for instance, they're working with. That's going to be what starts to really generate the funds. I think the other thing is, as I said, Google's trying to do that too. And they're not a small company. I mean, relative to OpenAI, they make OpenAI look very small. So, it'll be interesting to see how those two kind of do battle and where that leads OpenAI.
Yeah, I mean, just to, what I thought of as you were talking, like if you think of something that's a subscription model, I know it's not the same at all, but I think of Peloton, right? Where you pay a certain amount a month, whether you have the hardware or not, and that's not enough to sustain the kind of investment. So to your point, they need even to ratchet up, they need the enterprise customers because it's not paying for itself.
Those are going to be the ones that do it.
Yeah.
I mean, bad, poor Peloton.
Well, that's a whole other story.
Yeah.
Dan, thanks a lot. Appreciate it. We're just getting started here on Market Domination. Coming up, Tesla shares riding lower today after third quarter delivery slightly missed expectations. We'll break down the numbers with an analyst on the other side. Plus, shares of Nike falling today after the footwear giant withdrew full-year sales guidance and postponed its investor day. We'll check in on some of the top trending tickers on the other side. Plus, shares of U.S.-listed China tech stocks like Alibaba and JD.com have been rallying again today. We'll be joined by an analyst later in the hour to discuss the latest stimulus rally and whether you should be buying into it. All that and more when Market Domination returns. Tesla reporting third quarter deliveries today, just under 463,000 and up about 6% year over year. This coming against the backdrop of an auto industry that has been struggling. We've seen sales reports from Ford, General Motors, and Stellantis all come in weak as well, not to mention a bunch of European automakers cutting their forecasts. For more on the state of autos, we're bringing in Tom Narayan, lead equity analyst of global autos at RBC Capital Markets. He's here in the studio with us, which is exciting. Good to see you, Tom. Let's talk about Tesla first of all here, because these deliveries were kind of meh, right? But does it even matter? Is everybody just waiting for the robotaxi?
Yeah, I don't actually think it matters. Frankly, I thought they were kind of boring. They came in really in line.
You don't say that about Tesla very often.
Yeah, I mean, this is pretty well telegraphed. We knew the July and August numbers for all the countries. We're missing September. We had the China insurance numbers. We knew Europe would be bad because of tariffs, et cetera. So the US was the missing piece of it. We knew they cut pricing, but didn't expect the quote unquote whisper number to be as high as it was. For the stock to be down 3.5%, what is that, like $30 billion on something like this seems kind of odd. I think most folks are just trading into the robotaxi event. They already traded up into it. Maybe there's some profit taking. I think that's what's happening.
Do you think, Tom, they Musk can hit that full delivery consensus for the year, full year?
Maybe not. I still forecast it coming down year over year, but consensus is also down. But I think that's less kind of important. Car business for me is less, like 5% of my valuation, right? They need to sell cars to sell FSD and everything else. But I think folks are going to start looking at the bottom line more on gross profit. You're going to have regulatory credits, which surprised a lot of people last quarter. It's going to be good this quarter again and next year. And energy storage. People are finally talking about this. We saw the number that they printed today. It wasn't as good as last quarter, but way bigger than the run rate of last year. So I think folks are going to stop looking at the delivery numbers so carefully and start looking at gross profit, and it's going to look pretty good.
And what about this robotaxi event, right? Because we know the event's happening. We don't really know what they're going to say. We certainly don't know what the timeline is going to be of this thing. And the company has really, and Elon Musk has placed a lot of importance on it.
Yeah, I mean, it's half of my entire valuation, as you know. I'm a big believer in the robotaxi concept. The difference, though, between this event and what they held in a Power Day a few years ago, where the stock was up quite a bit, is Power Day was more real now, whereas I think robotaxis are a little bit farther away. That's why I think it might be difficult to get crazy excited, at least a stock to react the way it will be. I think it did into it. But I do think you'll get a lot of people like me writing big reports finally with real numbers and putting it in their models. That might help. But again, this is far into the future, so I just don't know how much it's going to impact.
Here's my question. Why is it so far into the future? We've got Waymo on the streets of cities now that are driving around without anybody in the driver's seat. Why is Tesla taking so long?
Well, I mean, how many Waymos are really on the
streets? No, there aren't that many, but the technology is working.
Yeah, I don't think it's really a technology issue. It's more of a regulatory issue. We all saw what happened with GM Cruise having to pull away and now starting to tip their toe back in. Cities are going to have to completely re-engineer themselves. I mean, try putting a robotaxi in the Champs-Élysées. I don't know if you've been driven there. It's nuts.
The roundabout, yeah.
It's a very human-driven thing. Let's put it that way. You're making decisions all the time. And so it's going to take a while for regulators to be okay with that. I mean, maybe in China they'll be okay with, 1,000 deaths for every 30,000 non-robotaxi deaths. But in the US and Europe, it's very difficult to make that argument that, well, less of you died, So I do think that from a regulatory perspective, it's going to take a long, long time.
What about, can I just get a quick take on the Cybertruck and what you're seeing there, Tom? I know it's small compared to Model 3 and Y, but what we're seeing and what you expect to see ahead, just anecdotally, I see them on the road.
Yeah, especially where we are now, right? I think it's more of a halo type car. They were trying to reinvigorate the brand. It is using 4680 cells. There's a lot of innovation in there. Now, as really having an impact on financials and volumes, I don't think it's a real game changer. If anything, they're losing money on it. But it is trying to get excitement back into the brand, which maybe they lost a little, right, compared to where they were. But really, ultimately, it's a halo car, right, that hopefully lifts their brand.
So, Tom, I have to admit, we did not intend to have you here just to talk about Tesla. We were going to have a bigger car conversation, but as usual, we end up talking mostly about Tesla. But I do want to ask you about the backdrop for the other automakers, right? Are there, even though we're watching the robotaxi event, are there other opportunities to get in here? Because the backdrop feels a little bit dire right now with all of these cuts that we're seeing.
Yeah, this is really what I've been getting into lately is we've seen these 4 European companies, big ones, all profit warned, big time. Like 40% cut, 50% cut to their profits. And the stocks have only been down like 10, 15%, which is not little, but compared to how much estimates cuts, which makes people think maybe this space is kind of interesting. I think we need to be a little patient because the reasons why they're cutting are kind of scary. And that is the fear that pricing comes down and there's no more capital return. And the other thing people are looking into is who hasn't cut yet? The US hasn't cut yet. We had numbers come out today at dealer inventories, ATP's pricing from Ford and GM. I'm a little worried about Ford. Inventories went up even above Stellantis' level. They just profit warned earlier this week. So folks are now looking at the US and wondering, are they going to start cutting? I think GM seems like the numbers were pretty good. Ford was the area I think folks are kind of worried a little bit.
All right, we will be keeping an eye out and keeping in touch with you. Thanks so much, Tom.
You got it.
Good to see you. Now it's time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. And let's look at Humana. Those shares are down 11% after recent changes to the government's quality ratings that could eat into the company's bonus payments, or really premium payments. The insurer warned that fewer of its plans would be rated 4 stars or above, hitting profits in 2026. We're talking about Medicare here specifically. And what's happened here is that Humana has become more and more reliant on Medicare. Really, out of all of the health insurers, it is the most reliant on Medicare. And so its profits are very closely tied to these so-called star ratings, which is a complicated process. But suffice it to say, 25% of its members will now be in highly rated plans versus 94% previously. These are higher revenue plans for the company. So this is going to cost it a lot of money. I'm seeing some really high estimates out there.
Yeah, I was reading reports saying Humana thinks CMS may have made errors in its calculation and apparently, appealing some of the ratings. But I was seeing analyst side saying the cut was way worse than even bearish investors thought it would be. Interesting column in the Journal I would just point to as well, pointing at Cigna. Obviously, considered this tie up with Humana last year. Humana was, of course, worth a whole lot more at that point. Cigna walked away after shareholders balked.
Right.
And now the Journal was kind of raising this question of does a merger now look maybe more palatable?
Maybe it does, but in the meantime, analysts from Stephens as well as Cantor Fitzgerald says that this change in Medicare could affect up to $3 billion in revenue for Humana.
Big chunk.
Yeah.
All right, moving on. We're watching oil prices here holding on to gains as Israel vows a painful response to Iran's missile attack. And joining us now is the Schork Group principal, Stephen Schork. Stephen, it is great to see you. So, oil is extending these gains, Stephen, but maybe not as much actually as some might have thought, given what we're seeing in the Middle East and what could be coming. I'm wondering, what are the reasons for that you see?
This has been the general theme for the past year when essentially the war in the Middle East broke out last October 7th. And that is to say that the market traders are supremely discounting the potential of a prolonged disruption to the flow of oil around the world. So I'll give you for instance. So last October, in the midst of the tragedy that began on October 7th, volatility in both the Brent crude oil market and the NYMEX WTI market was trading, I'm just looking at my numbers here, at about 38% implied volatility. So what does this mean? This means that on any given day, the typical price return on either contract was about $2 a barrel. Now, from October through the lull of the summer, that volatility was halved to about 20%. So that price return, daily typical return, dropped to around $1.10 to $1.20. So clearly, this was a risk premium that was never priced into the market. What we've seen since August now is volatility, implied volatility, and this is the market's estimate of future volatility, has slowly ticked higher to now, whereas a typical daily price return is about $1.50 So that led up to the events that we saw this past week. So what we've seen over the past 2 months is volatility or risk premium slowly being priced in. But once again, the general theme here is traders just do not think they're putting a maximum of minimum concern that we'll see a prolonged disruption. And quite frankly, I am perplexed, but this is the market that we have to trade in.
So, in other words, you're perplexed because you do think there is a higher likelihood than is being priced into the market of a more major and prolonged disruption of supply from the Mideast?
Oh, absolutely. We've already seen a major disruption to the flow of waterborne crude oil. That is, crude oil put on tankers in the Middle East, having to avoid the Red Sea, having to make longer journeys with fewer backhauls. So the expense of chartering, insuring, and moving a vessel of oil over the past year has rallied tremendously. And yet that rally, the cost to move oil has not really transferred over into the price. So I think the market is clearly underestimating a potential. And therein lies the concern here that if the market hasn't priced in a risk premium, and again, admittedly, implied volatility has increased over the past 2 months. So this is a telltale that some risk premium is being priced in. But relative to where we were a year ago, the market has not priced in nearly enough risk. And God help us if we do see an escalation of the war in the Middle East, and we know we are going to. The question is, does now Israel go after Iran's oil and gas infrastructure, which has been hinted in the market? If we see a disruption of that, and then, of course, what is Iran going to do? They're going to lash out, not back at Israel, but they're going to go after Saudi and the other Arab producer, not other Arab producers, Iranians and Persians, of course. So they're going to go after the other infrastructure. So we are really playing a dangerous game here, where we are really at risk of a major disruption to the price of to the movement of oil, and the market has not priced in this risk.
Let me ask you, Stephen. Let's say Israel did target Iranian oil facilities. Help us quantify that. I mean, how many barrels could that knock offline? And also, do you think if that happened, I'm curious, do you think the Saudis might step in and try to fill that gap at that point?
Well, certainly would. And I'm talking keep in mind, allegedly we have an embargo, or there's an embargo on Iranian oil, but we're still talking about a few million barrels of Iranian oil that's making it to the market every single day because they are flouting the tariffs and countries because they can buy Iranian oil at a discount because of these embargoes. Certainly have a demand there. But if we knock out of that, is to say, if Israel knocks out that ability, we're taking 3 million barrels potentially of Iranian oil off of the market. Now, there is about a 5 million barrel margin that OPEC could fill, and i.e. that would be Saudi Arabia. So clearly Saudi Arabia would stand to benefit this. But let's keep in mind, the Iranians, Shia Persians do not really like Arabs, Sunni Saudis. So if they see a move by Israel to take out their assets, Iran's going to respond they'll respond to Israel, obviously in a military sense, but they'll go after Saudi Arabia economically. And this is really the game we are playing right now. It's an extremely dangerous game that, yes, Saudi Arabia can fill the void. Bottom line is, it's very unlikely Iran is going to allow them to fill that void.
Stephen, great to have you on the show. Thanks for joining us.
Thank you.
Stick around, much more market domination still to come.
Escalating tensions between Israel and Iran are ramping up concerns about a wider Middle East conflict. Meantime, stocks are kicking off October under pressure as markets proceed with caution amid these heightened geopolitical worries. Here with more on the risks that investors are facing, we're joined by Ian Bremmer. He is founder and president of Eurasia Group and G0 Media. Ian, it's great to see you. We always like to get your views on these kinds of situations that we're currently in. I do want to start with the Mideast because there we are seeing tensions ramp up. We, of course, had Iran fire a number of ballistic missiles towards Israel. Doesn't seem that they have done much damage, but now we could see in Israel retaliation. Where does this go, and how should investors be thinking about it?
Well, they killed a Palestinian, apparently, and in the West Bank, but there were 2 light casualties in Israel that we know of and no fatalities. Why was that? Well, even though this was a lot of ballistic missiles, so it was a significantly greater strike that brought with it greater danger than we saw back in April, it was clearly telegraphed to the Americans many hours in advance, which of course meant very easy for the Israelis to have the alerts, get people in safety. Of course, they have extraordinary missile defenses. The Americans also involved in that. The Jordanians also knocked down a bunch of missiles crossing over their territory. So you put it all together, it was very hard for the Iranians to cause any significant damage. Having said all of that, and this was a retaliation. It was a retaliation specifically to the Israelis assassinating Hamas's leader in Tehran during the presidential inauguration in Iran. And of course, also, we can't sleep on the fact that there's been this significant escalation in the northern front of Israel against Hezbollah, including a ground offensive, lots of airstrikes, and the assassination of Hassan Nasrallah, their leader. So, you know, the intention from Iran is they don't have any good ideas here. They have no useful diplomacy that they can deploy. They want to try to deter the Israelis from further attacks. They have no good way of doing that. Their principal deterrent against Israel, Hezbollah, is getting utterly pounded right now and can't do very much in respond to Israel. If they do absolutely nothing, they look incredibly weak, both in terms of their position vis-a-vis the axis of resistance that they ostensibly support, and also domestically, especially with a very old and ailing supreme leader that isn't hanging on for much longer. So they clearly tried to meet in the middle. They tried to do something that was more significant than April, but that wouldn't cause so much damage that the Israelis and the Americans would respond. Having said that, the Israelis are in such a strong military position. They're on a roll, as it were, and the prime minister is very popular in this environment, unlike what we've seen over the last year, that he's looking for excuses, both to hit Iran further and degrade their military, maybe even their nuclear capabilities, and also bring the Americans into the war. And that is exactly what we have to watch out for over the coming 24, 48 hours, is what does that retaliation look like? Is it the Israelis taking the lead? Are the Americans able to contain them? Are they playing a direct role? And what kind of impact do we have? Clearly, the Iranians will try to minimize the nature of that retaliation, but depending on what happens, it may be very hard for them to do so. One other point I'll make, the Iranian government claimed that 90% of their missiles hit their targets in Israel. They claimed that this was a spectacular attack, which, of course, could not be farther from the truth, but it's very important to see why they did that. They're trying to show the Iranian people and their allies in the region, their proxies in the region, you see, we did all this damage, we supported you, when the reality is they've done nothing of the kind. And so they are clearly trying to show everyone that this is all that's going to happen and hopefully calm things down, hopefully have stability going forward.
Ian, does Israel have the capabilities to target and take out Iran's nuclear facilities on its own, or no, it would require U.S. assistance?
I think the answer to that is no. They certainly have the capability to engage in significant strikes in Iran. They could hit critical infrastructure. You'll remember the last time what the Israelis struck was a radar installation that is involved in the defense of Iran's nuclear program. So clearly sending a very strong message. We take the radar. Next time we may take the nuclear capabilities itself. But if you look, for example, at the enrichment facility in Fordo, it's very deep underground. It's under meters of granite. It's unclear. I'm not a military expert, but the people I talk to that are say that they do not believe the Israelis would be able to take out that facility and others like it themselves, that would require the Americans. And of course, to the extent that that's true, it gives the Americans a lot more leverage over Israel when we talk about Iran compared to places where they can act with comparative impunity, Gaza, the West Bank, Lebanon.
Ian, I want to turn to another area of the world that's been getting a lot of attention recently, and that is China, because of a bunch of new stimulus that the authorities there have announced. Now, we have heard talk of stimulus before that has caused enthusiasm, and then it hasn't really worked in the way that they wanted it to work. What's your assessment of this round, especially considering we're coming up on an election where we might hear some more China rhetoric from here in the U.S.?
Look, it certainly worked after the financial crisis, right? So, I mean, it's not like the Chinese can never do stimulus that has an impact. And those were shovel-ready projects, and it made a difference. The global economy moved. This time around, it's a much smaller increment. We're talking about probably, let's say, up to 1.5% of Chinese GDP, though there are senior economists in the Chinese government that are talking about much larger numbers than that in the coming months. Now, 3 months ago, 6 months ago, there was virtually none of this talk. It was all incremental responses, no major fiscal stimulus. That's a change. And a lot of people didn't expect that change until after U.S. elections, in part because the Chinese wanted to keep their powder dry. If let's say Trump won and really intended to put 60% tariffs across the board on Chinese exports to the United States. Clearly, the Chinese government is now seeing and saying that their economy has been structurally more problematic for longer, and that they're starting to fear social discontent with the government for a broader economic impact it's having, not on just the wealthy, but on the business, on the working and middle classes in China. So that's why you're seeing it. But of course, to the extent that they're starting in significant stimulus, that also means that coming out of that stimulus and being more willing to be more assertive, especially vis-a-vis the United States, but maybe other countries too, on the economic front, on the security front, which they haven't been willing to do for the last year, should be something we're now paying attention to.
Ian, I'm curious, Kamala Harris, how does she think about China? You know, in terms of a policy framework, Ian, would you suspect it would be a mirror image of Biden, or no, there would be contrast there?
No. I mean, differences on other issues, but not on this one. I think specifically on China, Kamala Harris and her foreign policy and economic team would be close to in lockstep with Biden. Biden's policy has been reasonably successful. It's also been broadly supported in a bipartisan way. It's been tough in defining national security pretty broadly. You've seen, the semiconductor export controls, for example, the Biosecure Act that they're trying to push through right now. You're seeing the maintenance of all of those tariffs from the Trump administration, lots of support, military support for Taiwan, building new architecture, the peace deal with South Korea and Japan at Camp David, very significant, the Quad getting stronger, AUKUS, all of those things without giving up the store. There's been very little in return that the Americans have given to the Chinese, and yet the relationship is managed better than it was a year ago. There's been a lot of high-level engagement, including something the Americans really wanted, high-level military-to-military engagement, so you reduce the dangers of escalation out of control over South China Sea, over Taiwan, over other issues. So I think Kamala Harris is broadly both comfortable with that policy and is not facing any particular pushback from either her base or from the Republicans if she decides to go forward with that.
Ian, gotta leave it there. Great to catch up with you as always. Appreciate it.
Yeah, my pleasure. See you guys.
Another earnings season is quickly approaching. Estimates eyeing a fifth straight quarter of year-over-year earnings growth for the S&P 500. That's according to FactSet. For new investors looking to get in on the action via options, we're looking at beginner trading strategies to consider. And Yahoo Finance's Jared Blickery joins us now with more for the Options Pit, sponsored by Tasty Trade. Jared.
Thank you, Josh. Let's get down to brass tacks with options. Quite simply, they're financial contracts with a buyer and a seller, whereby the buyer has a right, but critically not the obligation, to buy or sell a stock at a predetermined price. Now that's called the strike price, and it also comes with the condition that it all happens within a specific period of time. Now we've had options that expire each month for decades, and now we have weeklies. We even have some dailies. So the bottom line is the universe of options is expanding. And before we dive into the mechanics of the trade, let's talk about the decisions you're going to be facing. First, which stock are you betting on? How do you feel about it? Bullish or bearish or neutral, like Switzerland? What is your strategy? Are you looking to hedge your bets, or do you just want to generate some income? And you also have to consider volatility. How crazy are the actual swings relative to what's been priced in and forecast by other options traders? And lastly, don't forget the clock is ticking. Expiration dates matter for options. And finally, there's the strike price, or the make or break number you're betting on. Now, before we go any further, we got to talk about risks. Options can be a roller coaster. They use leverage, which can magnify both your wins and your losses. So that's the fun part, and also potentially the scary part. Complexity, there's a lot of math, and you really do need to understand the Greeks. That would be delta, gamma, theta, vega. They're beyond the scope of this discussion, but there's some homework to do there as well. Time decay is another one, and that really gets back to that ticking clock. So time is not necessarily your friend if you are an options buyer. But there are a few benefits to options. Leverage is not only a risk, but if you let it work in your favor, it can be a huge benefit. It's all about controlling a large trade with a small amount of money. Then there's hedging, which is a fancy word for insurance. Options can be your safety net if things don't go as planned. And unlike other types of trading, options can let you define your risk. No guessing games. You can control how much you lose, which means a lot for peace of mind. Now it's time to get real. And we've got two main instruments with options. We got calls and puts, and you've got two potential moves, going long and going short. Going long means you've got the right to buy a stock with a call, or you've got the right to sell a stock with a put. Now you flip that to go short. And now we're talking about obligations when we're shorting. You must buy a stock if you've sold a call, and you must sell a stock if you sold a put. And that also depends if your magic strike price is in play. So let's take a deeper look at a single option. When you buy a call, you're buying the right to own 100 shares. And 100 shares can be a pretty high dollar amount. And that gets back to leverage. The key factors and numbers you need to pay attention to are the expiration date, that strike price that you're aiming for, and also the premium that you pay upfront if you are buying an option. If the option expires worthless, that's called out of the money. You lose a premium as a buyer. If you're a seller, you pocket that premium up front. Now let's bring it home with a real-world example. Let's say I'm bullish on Apple stock over the next few weeks, and I see right now it's having a hard time getting over the $230 price level. It's trading right now at about $227. So I think it can run if it just punches through 230. So I buy an Apple 230 call with an October 18th expiration. That's the third Friday of the month when we have monthly options expiration. And that means there's lots of liquidity in these things, meaning I can get a fair price. So I pay $3.03 per share, or $303 for the total privilege, which is my total defined risk. And that's the red shading on the chart right there. If Apple stock is above $230 on October 18th by day end, I get the profit over $230 multiplied by 100 shares. So 240 means $10 of profit multiplied by 100 shares for a grand total of $1,000. Not a bad deal. If Apple stumbles, I eat the $300 and live to trade another day. Hopefully.
Hopefully indeed. Thanks, Jared.
Thank you. Coming up, we'll get to a few more tickers that are trending on the Yahoo Finance homepage. Stick around. Much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Start here with JP Morgan downgrading Mercado Libre from overweight to neutral, and shares sinking there nearly 5% in today's trade. So JP Morgan takes a look, decides, you know what, it's time to step to the sidelines. They go neutral, time for a breather, is what they told their clients, Julie, saying limited room for upward consensus revisions, adding, we see short-term pressure on results coming from the ramping up of the credit card business and substantial increase in logistical capabilities.
Yeah, logistical capabilities, which are expensive. So they say those new distribution centers are going to weigh on margins for Mercado Libre. The shares, by the way, are up in the 30% range, traded here in the U.S. under that ticker MELI. So this breather, if you will, comes on the heels of some pretty good outperformance from the company. And JP Morgan takes pains to say long-term, they
like
are
it.
constructive,
Positive. Yeah.
as they say, or bullish, in other words. And so that's something that's worth noting, too.
Yeah, it is unusual, and most on the street have a buy on this one, but not JP Morgan now.
Well, they did until today. All right, let's take a look at Nike. Those shares have been moving lower today after the company opted not to issue a full-year outlook during the first quarter earnings call on Tuesday. The sneaker and apparel giant also canceled an investor day set for next month. All of this comes as Nike's in the middle of a CEO transition announced in September, with Elliott Hill taking the reins. And so this seems to be sort of that reset to allow him to come in and formulate his strategy before they come out with new numbers. But analysts and investors seem to be saying this is not going to be an overnight easy task. That seems to be kind of the bottom line, right?
It's going to take a while. I mean, stock really coming under pressure today. It's interesting just to check out what bulls were telling their clients. I mean, you really have to believe in Mr. Hill, of course. Team at Telsey Group, they haven't outperformed on this one. Telling their clients they are betting likelihood of a brand turnaround, more newness across the portfolio they think is coming. They do say, like last week's announcement, to bring in Elliott Hill as next CEO. Think early sign that turnaround can begin in 2026. That's their timeline. They expect to hear his initial thoughts during the earnings call in late December, which should help sentiment for the story, in their opinion, and they're sticking with it.
Right. Well, even if that is the case, people have to wait to figure out what is going to happen
It's a battlefield.
next. Exactly.
All right, while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blicker to get you up to speed on the action from today's session, and let's start with where the major averages ended the day. Not too far from where they started the day, but there was a lot of kind of bouncing around the unchanged line during the course of the day, finishing higher on the Dow by about 39 points. That's about 0.1%. Of course, we had the ADP jobs number this morning coming in better than estimated ahead of the Friday jobs report here. And still the geopolitical backdrop of interest to investors, but really feels like folks are waiting for that data on Friday morning to place some larger bets. In the meantime, the S&P 500 not even up a point today, and the Nasdaq also not moving quite so much, up 0.1% here, up about 15 points. I've been watching volatility as well, which has come down from where we saw it yesterday when we saw a little bit of a spike up, and then it's been coming back down to some extent, but still hovering around 19. And then also just wanted to mention what we're seeing in the bond market after that data today, a little bit of a tick up in yields. Jared?
Yeah, let's stick right here on bonds. I just want to show you something real quick. Here's the year to date. We have been heading higher on the 10-year, and that's fine for the time being. But what is a little bit concerning is the U.S. dollar. I'll put some candlesticks on here, and you can see up 3 days in a row into potential resistance here that we have at 102. So just a little bit higher. But my point is, on the grand scheme of things, on a 3-year basis, we might be heading towards this upper end of the trend channel or horizontal resistance. If that is the case, then that could spell some trouble for equities. We were just running some stats from Ryan Dietrich earlier in the day. When we have a strong 9 months like we just completed, sometimes October tends to be a bit negative. So we actually have a bearish seasonality for the month of October. It doesn't have to happen, but we are on alert for that possibility. With respect to the sectors today, energy in the forefront, that is up over 1%. Then we have tech behind that. Tech was a big loser yesterday. Today, the biggest loser is consumer discretionary. That is retail, things people want, and then staples, things people need. So the retail trade a little bit off today. And we're seeing in the Nasdaq kind of a mixed bag with respect to the mega caps. NVIDIA, after the chips leading down yesterday, up 1.5% today, clawing back some of those losses. Tesla down 3.5%. Mercado Libre down 4.6%, but not a lot of standouts except for China. And China has just been on a tear. I think this screen behind me on a relative down day or a day of inaction is very representative of what's going on. Just take a look at the last 10 days. 36% for Baba, Pinduoduo 50%. Some of these guys are in the multiple hundreds of percent. So impressive work by the Chinese authorities so far.
Jared, thank you. Markets showing signs of calm after the volatility spike tied to the rising tensions in the Middle East. Joining us now is Sean Bonner, Siebert Valor, Chief Market Strategist. Sean, good to see you. And let's start with those rising tensions in the Middle East. Sean, I'd imagine you're getting questions from clients today. What have you been telling them?
Well, what we've been telling them is welcome to October, right? There's always a season of volatility here, and you never know where it's going to come from. And now we're seeing it with these geopolitical macro tensions. And the war in the Middle East is certainly escalating, and we're waiting for an impending response from the Israelis. And depending on the strength of that response and how it looks, it could really set the table for the rest of the month.
It could, Sean, but at the same time, we've definitely seen this movie before in the sense that you get a geopolitical event, you get sort of a reaction in the market, then it fades, and you don't really see the market react after that. What would have to be different here in order for there to be a bigger or more sustained reaction?
Yeah, I mean, I think it's pretty clear. It's one clear event. If the Israelis decide to go after the Iranian oil infrastructure, specifically at the Karg Island oil terminal, that supplies about 7 million barrels a day of oil coming out of the Persian Gulf. If the Israelis really are saying we've taken the gloves off and we want to cripple the Iranian economy, but we don't care about spiking oil prices, that's going to be their number one target. And if they do that, sort of all bets are off the table as far as what the oil price is going to do and how energy prices are going to react.
Sean, let's switch gears, talk about some of the economic data we got today. ADP came in better than expected. Of course, we have the big jobs report on Friday. What are you looking for there, Sean? How important is that?
I think it's everything, right? The Fed is, been really in this inflation battle for some time now, and kind of decided that we're cutting rates and we're moving forward. But I think the big driver behind that's been weakness in employment, right? Unemployment's ticking up at 4.3%. if we see a couple other issues with inflation, though, with this longshoreman strike and with energy prices going up, the Fed could be really caught between a rock and a hard place. So, the Fed gets caught between this dual mandate at times like this, maximum employment and price stability. So all eyes are going to be on this report to try and figure out what maximum employment looks like for the Fed.
And Sean, I know you're really focused on affordability in this economy, right? There has been a lot of economic ink spilled, so to speak, that the economy is doing okay, but that indeed lower income folks are struggling. How do you think about that, and how does that inform your investment strategy?
Yeah, and really, it's just not lower income folks. I mean, I think it's 2/3 of American households are really on the precipice of an affordability crisis. When you look at the cost of housing, when you look at the cost of food and energy, when you look at the cost of the basic needs for people, the price spikes we've seen over inflation over the last 4 years, even though inflation numbers have come down, but inflation is just simply the rate of increase. So we've seen these massive spikes in basic needs, basic goods for people over the last couple of years. People are still recovering from it. Just because the rate of increase is slowing doesn't mean it's getting any better. If I put on 10 pounds a couple of years ago and 12 pounds the year after and 8 pounds the next year and only 3 pounds last year, well, I'm putting on less weight, but I'm still 30 pounds heavier and I'm still unhealthy.
I'm just curious, that figure that you cited, 2/3 of Americans on the verge of an affordability crisis. How do you define that? What does that mean?
So if you let's just take the housing market. So some estimates say that there's over 4 million households, 4 million people looking for households that can't afford it, right? There's 4 million people that want to buy a home, that have enough for a down payment, but they simply can't afford the principal and interest payments. So if we see mortgage rates coming in, they'll be able to get into the housing market. But it still remains to be seen that if real estate's really the real estate market's going to open up for these folks, if they're going to be able to have access to funding and access to mortgages. You look at food and energy prices, you look at the cost of healthcare, you look at the cost of secondary education. All these things are seeing record highs in a short amount of time. So I think it's more the price shock. It's how quickly and how rapid these prices have risen is what's contributing to this crisis.
Let's talk politics finally, Sean. We had the VP debate last night, Vance and Walz. How are you thinking about election risk?
Yeah, I mean, I think that's always a risk that we always look at every couple of years. I think it tends to be kind of overestimated. Look, betting against America has never been a good idea since 1776. So I think in the long term, things will be fine. And, the stock market, in terms of where we're looking at now, we're at near all-time highs. We're at near all-time or historically high PEs, and we're also at historically high revenues. So, the market's in a good place. Revenue growth and revenues for the S&P 500 will continue to drive the market. The corporate tax cuts that we've seen over the last administration, if they expire and they want to raise corporate taxes, that will go directly to hurting corporate profits. So that could be a potential red flag. But other than that, I wouldn't get too concerned about who's in the White House.
Sean, thanks a lot. Appreciate your time.
Thank you.
Well, Tesla shares slid in today's trade as third quarter deliveries fell short of expectations. Investors, though, are of course now turning their attention to the company's robotaxi event next week. CEO Elon Musk has touted the future of vehicle autonomy for years. Any details could potentially provide a lift to a stock that's flat on the year. Yahoo Finance's Akiko Fujita joins us now with more. Among those folks who is optimistic about that autonomous future, Tom Narayan, who we spoke to earlier today, Akiko.
Yeah, interesting for him to talk about, how he expects it to be a significant part of Tesla's valuation. As you said, Elon Musk has long touted vehicle autonomy as the future of Tesla. At the company's investor day earlier this year, he said the technology would increase the company's valuation tenfold. There's been plenty of speculation about what exactly this announcement will be. In the past, we've heard Musk describe his robotaxi vision as part Uber, part Airbnb, fully autonomous cars, allowing Tesla drivers to share their vehicles on an app, tapping into a wider network to cash in. Musk has also talked about the potential for a car specifically designed for autonomous taxi service. The reality is there's already a handful of companies that have beat Tesla to the market on this. You've got Google's Waymo, that's been the market leader, offering more than 100,000 paid autonomous rides per week. The company's been offering fully autonomous taxi service in San Francisco, Phoenix, and LA. Today it announced it's expanding to Austin in a limited capacity. Another competitor, GM's Cruise, has had a rougher ride. The company suspended its fleet after a string of high-profile accidents. And just this week, Cruise agreed to pay a $1.5 million fine for failing to report one of those accidents. And then there's Zoox, which is owned by Amazon. The company is planning to enter the ride-hailing market next year in Las Vegas. Their vehicle has no steering wheel, no pedals, no driver's seat, as opposed to its competitors that retrofit cars meant for human drivers. Zoox is offering a ride that's built solely for autonomy. Co-founder and chief technical officer Jesse Levinson says that also makes these rides safer than its competitors.
We're able to have 2, or in some cases 4, of almost every important critical component in the vehicle. So that means we have 2 braking systems, we have 2 steering racks, 2 batteries, 2 motors. We actually have 4 sensor pods, 1 in each corner. And what's really cool about our vehicle is if any one of those components has a hardware or software failure, not only is it still safe, but we can actually keep driving and take the customer to their destination.
In addition to safety, there are questions about the business model for robotaxis, what that means for profitability for these companies. Chris Robinson with Lux Research says autonomous taxi rides today cost roughly half that of traditional ride shares when measured per mile, but it still costs 2 to 3 times more than car ownership. He points to the high overhead costs, all of those factors you see on the screen there, as one reason why he thinks this technology may not be as disruptive as some analysts have suggested, guys.
Akiko, I also want to ask you about regulation, which is something that Tom Narayan of RBC brought up, as well as potentially a limiting factor. That and sort of the way that some cities are constructed that might be tougher to navigate than others.
Yeah, and this is where it's interesting to see what Tesla actually comes up with on specifics, because you look at regulation right now, it is very fragmented from city to city. But the reason why those like Tom and other analysts have brought that up in the context of Tesla is because Elon Musk in the past has talked about not necessarily geofencing the area. When you think about somebody like Waymo today, they actually go out and digitally map these roads and these routes with a human driver behind the wheel before actually deploying those autonomous vehicles. Tesla doesn't necessarily see that vision. They've talked about sort of learning through driver data, and that would require, some engineers have said, a lot more guardrails in place here in terms of security. The risks are higher, according to some engineers. But of course, we're going to hear what Elon Musk has to say next week about how exactly he plans to deploy these robo-taxis, what the timeline is, and what exactly that technology is going to look like. Because right now, what he said in the past is very different from what Waymo as well as Zoox has offered up so far.
We shall see. Akiko, thank you so much. Coming up, shares of Levi Strauss falling following the latest earnings numbers. We're going to get you the details on the other side when Market Domination Overtime returns.
Geopolitical tensions are on the rise. Concerns about a wider war in the Middle East grows as the conflict escalates between Israel and Iran. President Biden expressing support for Israel as U.S. military forces aid its defenses. This all putting companies such as Palantir in focus, which of course does business with the U.S. government. Palantir head of defense and former Republican Congressman Mike Gallagher joins us now to discuss. Mike, it is great to have you on the show. I want to start just big picture, Mike. Interested to get your take of what you make of what we're seeing in the Middle East, Mike, right now, those tensions, and what you think could be coming next.
Well, you saw Iran lob something like 187 ballistic missiles at Israel, thanks to Israel's amazing defense technological prowess. Most of those were neutralized. In fact, the one casualty was a Palestinian. However, it doesn't take a large stretch of an imagination to think what could happen if those missiles were armed with nuclear warheads, as they all could have been, which should add urgency to our efforts to ensure that Iran does not get access to a nuclear weapon. So how do we do that? Well, remarkably, Israel is showing us the path back to credible deterrence by taking decisive action to degrade Hezbollah's military capabilities in particular. They've launched an attack on Hezbollah's stronghold in South Lebanon. They've uncovered over 1,000 terrorist sites armed to the teeth with weapons that were in many cases provided by Russia and Iran. It is imperative for us to support Israel's ongoing efforts to degrade Hezbollah and restore deterrence. Put slightly differently, Israel is actually winning right now. We just have to let them win rather than constantly trying to restrain Israel for fear of escalation. The path of de-escalation lies in victory, decisively defeating the Iranian threat network in the region.
So, Mike, on that point, let me ask you, I do see headlines here. President Biden does not support an attack on Iran's nuclear sites. Is that the right decision, in your opinion? Is that the right message to be sending?
Well, I don't think we should be signaling one way or the other what we won't do. And that's really the problem. We're constantly out there. The president is constantly saying, we won't do this, we won't do that. Or even worse, in some cases, laying down a clear red line and then not enforcing it. For example, the administration said that there will be severe consequences if Iran launches a direct military strike on Israel. Well, yesterday, Iran launched a direct military strike on Israel. So there better be severe consequences. And I'm not talking in the form of feckless sanctions, actual measures to impose costs on Iran. Otherwise, we will have zero credibility left. As for how more broadly we deal with the nuclear program, I've long believed that the American president needs to say loudly and clearly, Iran, you have a choice. Behind door number one lies us attacking your nuclear program if indeed you try to acquire a nuclear weapon. We're not going to invade the country or we're not going to occupy the country, but we will completely decimate the infrastructure. And a lot of people will get hurt in that process because of your bad decisions. And behind door number two lies access to a world-class civilian nuclear program that your population can benefit from and that we will help you build. It should not be a tough choice. And in the meantime, we can take direct action to not only degrade Hezbollah, as I talked about before, not only completely destroy Hamas in concert with Israel, but to destroy the Houthi rebels who are a terrorist proxy of Iran and who are attacking U.S. Navy ships right now. And if there are Iranian ships abetting that process, like the Iranian spy ship that's floating around the Bab el-Mandeb, well, that should be a licit target for us to neutralize, in my opinion.
Mike, I want to switch gears to another area of the world you know very well, which is China. I think we have a clear line of sight in how former President Trump thinks about China. What do you make of how Kamala Harris approaches China in terms of her policy framework, how you think it might compare and contrast with Biden?
Well, she hasn't said much about foreign policy in general and China in particular, so it's hard to get a sense of what direction she would go. Her closest advisor, Phil Gordon, did sign a letter that was basically a let's be nice to China, you know, they're our friends letter signed by a bunch of these experts, which worries me because that thinking really expired about a decade ago. It makes no sense in the modern day, and it is actually out of step with the bipartisan consensus that I got to witness on the Select Committee on China that I chaired, where Republicans and Democrats are saying in clear language that China is our foremost threat on the world stage. So I would guess, and all it would be is a guess, that Kamala Harris would either be a complete continuation of the Biden administration's approach on China or have a slightly softer approach to China, one that prioritized things like cooperation on climate change and AI regulation with China, as opposed to having a more competitive, hard-nosed approach. I think this would be a massive mistake, by the way. I hope I'm wrong about this analysis, because we now have over 2 decades of evidence to suggest that the more we try and cooperate with China on various areas, they take advantage of our good intentions and our naivety, and all they've been doing for 2 decades is waging economic warfare against American citizens, poisoning us in many cases with deadly fentanyl precursors, and also militarizing the South and East China Sea. So it's time to stand up and push back Chinese aggression rather than merely trying to accommodate or appease it.
Let me ask you about, you got a new job, of course. Palantir's new head of defense. Company's had a lot of success in that area, Mike. I'm curious how you see that business evolving from here. And also, given your unique resume, background, experience, contacts, whether you can open up new lines of business as well for Palantir.
Well, that's precisely my hope. And I think just we've proven the technology on the battlefield. It's been in the hands of our foremost warfighters, in CENTCOM in particular, obviously use cases in Ukraine, Israel as well. I mean, the proof is in the pudding. And now I think there's a massive opportunity to expand that technology across the Department of Defense to improve the way that the military makes decisions, and also leverages Palantir's technology to reduce costs in all the areas that may seem less exciting than how we target bad guys, but are nonetheless critical, like logistics in general, contested logistics, basic financial management, how every service secretary keeps track of what equipment he or she owns and how to move things around from point A to point B, how to manage a Marine, soldier, sailor, or airman's career so you have a 360-degree view of every single person in the military in order to improve recruitment and retention. These are the areas where I think Palantir is poised to succeed, as well as partner with other defense companies, marry our software, because we produce the best enterprise software in the world, to their hardware, and produce some truly unique capabilities for the Department of Defense. If you then combine all of those things in the defense space with the success that Palantir is having in the commercial space, working with almost every single industry, then things start to get really exciting, because those two things, obviously there are lessons to be learned in both sides of the business that can lead to even greater advances in the future. So I'm very excited also to be part of a company that is unapologetic in its defense of America, its defense of the West, and its belief that America is a force for good in the world.
Mike, great to have you on the show today. Thank you so much for joining us.
Thank you.
Shares of Levi Strauss are tumbling in the after-hour session following the third quarter earnings report here. Let's run through the numbers here. It looks like adjusted earnings per share coming in 2 cents above what analysts had been anticipating. Revenue slightly shy of estimates here at $1.52 billion. And gross margin ahead of estimates at 60% versus 55.6%. The company's full year forecast, though, does seem to be a little bit shy of what it had previously said. Before, it was looking for revenue for the year rising 1 to 3%. Now it's looking at the low end of that of 1%. And finally, it is also looking at a strategic review of its Dockers brand. So that's something notable as well. Looking through the numbers here, it looks like net revenues were pretty much flat across the company. In the Americas, they were down 1% here. The company talks a little bit about the exit of one of its businesses. Denizen is causing some extra costs. And also recall that it is buying Beyond Yoga. So that also caused some noise. But overall, the sales just not doing much here.
Yeah, I mean, the stock had a nice move heading into this. I mean, it's up about 30% this year, given a lot of that back up in the after hours. I know analysts were saying, Julie, they were focused on the health of U.S. wholesale, European wholesale, U.S. direct-to-consumer sales, new collaborations. Conference call does start shortly at 5 p.m. Eastern, so you would hope to get more color and commentary on those issues.
Well, I have 2 answers for you on what you were just talking about. Direct-to-consumer revenues up 10% here. So that's that number. From e-commerce specifically, up 16%, and wholesale revenues were down 6%. So interesting there that they did better in the direct-to-consumer channel, but not as well in the wholesale channel.
Anything about new collaborations? I'll have to wait for the call.
I didn't see anything on that. Well, we know that we know earlier in the week they said that they had signed a new deal with Beyonce and they released some ads. So that obviously wasn't reflected in this quarter, but it doesn't seem to be reflected in the forecast either. So I'm sure they will get some questions about that. And we'll have some questions for the CFO. He's going to be on tomorrow. Levi's Chief Financial and Growth Officer Harmit Singh will speak with Yahoo Finance's Brian Sozzi. I'm certain he will be wearing his traditional Canadian tuxedo, denim shirt, denim jeans. That's, Harmit, or he has a cool jacket usually. He'll be on at 10 a.m. tomorrow.
If you got it, you flaunt it, Julie. Come
of course.
On. All right, time now for What to Watch. Thursday, October 3rd, sponsored by Tasty Trade. Starting off on the economy, weekly initial jobless claims. Numbers coming out in the morning. Economists forecasting that to tick up to 222,000, giving us more insight into the health of the labor market.
Moving over to housing, we'll be getting new mortgage rate data from Freddie Mac in the afternoon. Remember, last week, we saw the 30-year fixed-rate mortgage dipping to 6.08%. That's the lowest since September 2022. This is going to be the second week we see how the Fed's 50 basis point cut last month will impact mortgage rates.
And taking a look at the Fed, we're going to get another batch of Fed commentary from Fed Presidents Neil Kashkari and Raphael Bostic.
And on the earnings front, Constellation Brands reporting second quarter earnings in the morning. Analysts expect the company's strong beer sales to lift EPS overall. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The economic implications of the port strike. So far, many companies have planned for the walkout, but if it lasts longer than expected, the ramifications could be wide-reaching. We're going to take a closer look at what we're hearing on earnings calls and how America's truckers are navigating this stoppage. Plus, we're counting down to the monthly jobs report, the ADP report, showing private payrolls rising more than economists had expected, but there's some bad news for workers changing jobs. We dig into that as part of our chart of the day. Plus, crypto under pressure, Bitcoin hovering around the $60,000 level. What's driving the action? Straight ahead. As the East Coast port strike enters its second day, retail executives are hinting at how they'll handle the disruption on this quarter's earnings calls. Here with more is Yahoo Finance's Brooke DePalma. Brooke.
Yeah, good afternoon. Retailers have been talking about this. They've either been pulling inventory forward ahead of these strikes. They've been switching inventory shipments into the West Coast, or now that it's actually happening, they're thinking, well, how long could this last? And what are we doing in the case that it should last beyond this very moment? So let's take a closer look. Nike CFO telling investors on its earnings call that they're watching this really closely. They said they haven't baked in anything for a timeline on the East Coast port strike, but there's a possibility that this could impact margins in the second quarter, as you can see right there. But they're not alone in this. We've heard from other retailers like Walmart and Costco that have prepared for this very moment. Yahoo Finance spoke to Walmart CEO Doug McMillon, and like many of us, he's focusing in on bananas here. He said that they have taken action to try and reduce risk, but there's a nature of the categories here is very different, with a large percentage of them being bananas. He said they can't pull forward bananas given the implication, and he hopes that it does settle quickly. Of course, we know that Walmart has been investing in grocery, and this port strike is really doubling down and impacting those perishable goods. Costco's CEO telling investors last Thursday on its earnings call that they have had contingency plans in place. They've cleared the ports, they've pre-shipped, and they've done several different things to get holiday goods in ahead of this time. But they said that it could be disruptive based upon how impactful. He said they can't tell you they know the length or what could happen in here, but their buyers are all over it and they're watching it very closely. And in addition to that, Telsey Advisory Group did speak to Lowe's. What they're saying here is they're one of the retailers that actually have shifted production to, or rather imports to the West Coast ahead of this in order to try and get ahead. But once again, if this lasts more than a couple of weeks, these retailers will then have to reshift, refocus, and re-strategize about how they're going to fix this.
All right, thank you, Brooke. Appreciate it. It is day 2 of the International Longshoremen's Association union strike at East and Gulf Coast ports. The repercussions are rippling into industries across the country, and one of those is trucking. And joining us now is Chris Spear, CEO and President of American Trucking Associations. Chris, it is good to see you. So let's dig right into the strike, Chris. I'm curious, the impact, the ripple effects you're seeing in your industry, the trucking industry.
Well, Josh, we're not even 2 days into this strike, and we're already seeing 62 container ships scrambled that were inbound at the East and Gulf Coast ports, carrying nearly 500,000 containers. My industry moves, as an example, 12,000 of those boxes a day at New York, New Jersey. We're already tracking multiple ports and seeing the activity diminish in Savannah and Houston, 100% shutdown in activity for trucks. If you go a little further out in Savannah, you're seeing truck activity and warehousing down 60% as those supplies and inventories begin to deplete. In Houston, 20%, but obviously more warehousing there than in Savannah. So we're seeing the activity really quickly unfold, and probably by through this weekend, if this strike continues, those inventories will be gone.
Chris, you want to see politicians get more involved?
This is just a pure lack of leadership, Josh. I mean, it is the responsibility, the job of the President of the United States and this administration, Vice President, Acting Secretary of Labor, to actually mediate, to bring these parties to the table when they can't reach an agreement. They haven't met since June. And you have the president out there saying, oh, it's collective bargaining. Well, that's true if they're actually talking. You got to bring them together to solve pay, automation, The sticking points that are outstanding aren't going to get resolved unless this president steps up to the plate and actually provides the leadership needed. The problem with that, Josh, this administration, this president have already taken a side. They've walked the picket line for UAW. They basically said they are in the pocket of big labor. Well, if you're USMX representing 36 ports that are now on strike, you literally have no incentive to come to the table if it's being mediated by this administration because they've already shown their cards. So this impasse could go on indefinitely without somebody with credibility brokering this deal. You better brace for this. We are, and it's going to be impactful.
Hasn't, Chris, though, the White House gotten involved to some extent, holding meetings? Are you suggesting it's just not getting enough done?
They touched gloves with each party. The parties did not meet. And they already knew what the parties were going to tell them. And as of Monday night, USMX put 50% pay increase on the table for the union. The average pay for an ILA worker is $150,000. You have crane workers making over $300,000. Now, I'm not saying 50% or what they're asking for is 77% is justified, but you're talking on a $300,000 salary, nearly $500,000 a year if that were to be granted. So this is about greed. This is not taking into the interest everyone in North Carolina, Tennessee, Virginia, Georgia, Florida, who are suffering and uncovering their communities from mud and water. Yeah, I don't think they really care right now about somebody whining for $500,000 a year. So there's a disconnect here. This administration better start focusing on real America and not union bosses.
What about Hurricane Helene and its aftermath, Chris? How has that impacted the trucking industry?
Significantly, and I'll tell you why. Usually in Florida, after a hurricane, our trucks are pre-positioned with aid and could probably be on the ground at site within hours. The problem we're having in, say, North Carolina, Tennessee, is that these communities are served by roads that have been completely washed out or covered by mud. So the infrastructure is so badly damaged, we can't even penetrate the circumference of that area. So a lot of the aid that's now going in is being flown in. So that's not a way that you're going to rebuild quickly. So it's a very complicated environment, now compounded by the fact that we have 36 ports that are now shut. So, we're talking North Carolina, there's a lot of port activity that would be providing aid. That's not happening now. So this is the worst time for this to happen.
Chris, it is great to have you on the show. Thank you for sharing your perspective. Appreciate it.
Thank you, Josh.
Yahoo Finance Podcast, Living Not So Fabulously, is helping you become more grounded with your money by learning from others' journeys. Here's a clip from the newest episode. And to check out all of Living Not So Fabulously, as well as all the Yahoo Finance podcasts, scan the QR code below or check out the Yahoo Finance homepage.
The idea of you talking to directors, casting, all these different people, the vast majority of us don't go to our boss and say, do you think it's okay for my career if I come out?
Yeah.
Right? It's either we do or we don't.
Right.
Well, we have those kind of internal dialogues. But what about you as a couple financially?
I think we were fortunate in that I had come out professionally. I was really part of my pitch to my first firm when I started on Wall Street. It was, I want to be a financial planner to same-sex couples. So I was out professionally and personally. I definitely respected the difference in pace that Dan needed to do as an entertainer. Right. It's a different, more broad-based audience, if you will, than what I was doing. But we were fortunate in that my career and income were consistent and stable in the fact of being out, and that was okay. And as we all know about actors and entertainers, there's a lot of variability with income anyway. So we had lived through that truth for years prior to him coming out. So we were prepared to, for whatever came in terms of pauses or so forth.
That was a challenging thing to prepare though for, because knowing, all those kind of warnings that people put out there, like, at the time I was playing, leading men for like I do the Lifetime movies and the Hallmark movies and all that stuff, and you're the lead. Yeah, but you're the straight guy, and there's a certain audience that those companies are trying to appeal for.
Right.
And they're saying if you have someone who's so publicly out, it was fun. We did it big. I mean, we came out like our wedding, People magazine, that kind of thing. So when it's so publicly like that, they're saying, can you also then play the straight guy in this? And so me just knowing, okay, I'm not going to have necessarily all those same types of roles, and that is going to be a financial hit,
right?
And being okay with that, so we did kind of prepare in that way.
What do you think you would have been able to come out, considering your finances, had you not been in a relationship with somebody that you could lean on?
I mean, that's a good question. I think I've been very fortunate that as you said, we've built a life together for the past 16 years, and I didn't feel that pressure in that way. But I think if I were single, that is probably something actors are struggling with now. To think about, is that financially in my best interest to do so? Because I think we have come really far now, as we see, in these past several years. But yeah, I think people have to think about that probably, which is hard.
Right.
So at that time, you must have had, at the very least, start to have the financial conversation at that point in your relationship. Mm-hmm. One of the questions that we're often asked from our listeners and viewers is, how do you get on the same page with your partner with your finances? So can you answer that question? Like, how did you two get on your same page financially?
I think it's different for everyone, just having been a financial planner for a while and then thinking about how we did it within our relationship. I think we started with common goals and values. There's definitely a trust factor there. Mm-hmm. Wearing my day job hat, there's also, some cautionary tales, right? You have to be careful in combining accounts. You can have ownership issues, potential tax ramifications. Luckily we were knowledgeable of those, but we began just gradually and sharing bills. Most couples don't have exactly the same incomes. Mm-hmm. So that's where the trust factor comes in, where, you put it on the chalkboard and these are our goals and this is what our budget is. And I think that longer term goal orientation is probably the tougher conversation than, say, the day-to-day logistics of, what account are we paying rent from, or who's going to pay the electric bill this month, et cetera.
Yeah.
In a sense, and it's probably not a very financial planner answer, it kind of works itself out.
So one would assume that you're probably the CFO of your household.
Well, let's not make assumptions.
I was going to say finance and flair, right?
The crypto ETF market got hit again Monday with over 290 million in combined outflows from U.S. spot Bitcoin and Ethereum ETFs. This coming amid escalating geopolitical tensions in the Middle East, leading to sharp declines in both Bitcoin and Ethereum prices. Bulk of the outflows were concentrated in Bitcoin ETFs, which saw over 240 million in withdrawals. And joining us now to discuss the state of crypto further is Zeke Fox, author of Number Go Up: Inside Crypto's Wild Rise and Staggering Fall. Also joining us, of course, is Yahoo Finance Julie Hyman. Zeke, great to see you again.
Hey, thanks for having me on.
So I thought maybe just start with kind of the price action we've seen in Bitcoin, which has been interesting because, and we were talking off camera, it was up about 8% in September, nice pop, and then gave about half of that in yesterday's trade. I'm just curious what you make of that price action. What's it telling you, if anything?
Yeah, I mean, when I talk to Bitcoin proponents, you get a lot of pitches about it's digital gold, it's a store of value, because Bitcoiners have pretty much given up on pitching it as something you're going to use to buy your coffee in the morning or whatever. Mm-hmm. But then from the price action, what we've seen is it's moving pretty much with other risk assets. And it's down today because the jobs number was looking pretty good, and it's less likely that the Fed is going to cut rates a lot, and that sends stocks down, and it also hurts Bitcoin. So it's moving a lot more in lockstep rather than like being a hedge the way they pitch it as.
Yeah, I mean, if you read your book, and it's out in paperback now, which is one of the reasons that we're talking to you, you definitely point out some of the flaws in the crypto ecosystem, if not with the cryptocurrencies themselves. And you were also, you were talking to Sam Bankman-Fried while FTX was sort of coming down around him. And yet here we are, crypto's still alive and well, right? You've got all these ETFs, you've got more institutional ownership, the price has been okay. So how do you kind of square that?
Yeah, it's pretty wild to see. I mean, Bitcoin has tripled since FTX failed, which was kind of like its lowest point. And I mean, the title of the book, Number Go Up, comes from something I heard a Bitcoin guy say at a conference. And he was like, if the price goes up, it gets people excited. Then more people will buy. Then the price will go up more. And before you know it, like to the moon. And I thought that was kind of laughable. But I really think that's kind of what's been happening these last couple years. People are just thinking, hey, if the ETF gets approved, then Bitcoin's going to go up. So like I should get in now. And I don't think that kind of thinking can last forever. But so far, it's led to pretty strong recovery for all these coin prices.
What do you make, Zeke, switching gears a bit, about how, and were you surprised by how crypto became this topic of interest during the election? And kind of, Trump kind of positioned himself as the crypto candidate. Harris is sort of, signaling general more support. I mean, what do you make of that?
Yeah, I mean, it's really wild, especially as someone who covers crypto. Sometimes it's kind of hard to cover all of this stuff with a straight face because we've seen so many scams, so much fraud, and people in crypto, I think, are even not talking that much about crypto's the future, Web3, like NFTs, like the excitement's gone, except in DC, where now you've got politicians who are basically repeating the industry's talking points. Mm-hmm. And I mean, I couldn't believe it. Trump came to the Bitcoin conference in Nashville and gave a speech where he said we should establish a strategic national Bitcoin reserve. I mean, it's a crazy idea. Mm-hmm.
Well, the Bitcoiners love it though, right?
Yeah, I mean, and they've pitched this idea that there's a lot of Bitcoin voters and they're doing this to appeal to Bitcoin voters. I really don't think there's a lot of people where crypto is like top of mind, but there's definitely quite a few really rich crypto guys.
There's a few guys who have a lot of money, Zeke.
And they're donating it.
Yeah.
Yeah. I mean, right before that speech, Trump held a fundraiser with Bitcoiners. They said they raised $25 million, which is, I mean, one of the biggest political fundraisers ever.
So, and they, that huge amount that they're giving, are crypto lobbyists going to cost Gary Gensler his job in the next administration?
I mean, I've been surprised again to see Kamala Harris making these kind of friendly overtures to the crypto industry. But you know what? I wouldn't make too much of it. The kind of stuff she's saying, like we want to be leaders in innovation, is the kind of stuff you could even see Gary Gensler saying while he still tries to impose SEC regulation on the industry, which it doesn't like. So I don't think she's like really tipped her hand too much, but would rather not see the whole industry, you know, donate another $25 million to Trump or whatever.
Zeke, always great to see you. Thank you for coming on set. Appreciate it.
Thanks for having me on.
Stick around. The Yahoo Finance chart of the day is coming up right on the other side. New ADP employment data coming in stronger than expected today, but what does that mean for people who are thinking about staying or leaving their jobs? Yahoo Finance's Julie Hyman joins me now with a closer look in our chart of the day. Julie.
Yeah, we love looking at these ADP numbers to try and slice and dice them, figure out what it means for the bigger state of the labor market, especially ahead of the jobs report coming on Friday. That's really going to be pivotal for the market here. One of the things our Josh Schaefer highlighted was the wage growth between people, the gap between people who are staying at their jobs and those who are leaving their jobs. What kind of increases are they getting on a relative basis? Well, if you look at people who stay at their jobs and what happened to them in September, they actually saw a 4.7% increase year over year, but that's been pretty steady here. What's interesting is the gap with people who change jobs and get a lift from that, that gap is narrowing as you see closely here. So people who switch jobs still got a 6.6% bump in pay, but that was the smallest gain going back to April of 2021. And the gap is the narrowest that we've seen since about January here. So this is just yet another signal, another sign that the job market is is changing and sort of normalizing, if you will. That's also been reflected in some of the overall jobs data that we have been getting, and that 4.2% unemployment rate. Of course, the big question next is this going to narrow further? Is it going to be another sign that we are seeing, again, a labor market that is continuing to normalize or even tipping into a worse situation? That's what the Fed is going to be watching really closely. That's why the jobs report on Friday is so important, and why it could signal to the market and give us hints about whether there's going to be a 0.5 percentage point rate cut or a 1/4 point rate cut. And these kinds of signals as well help us get some insight into the tea leaves as to whether we are seeing the job market tip over or whether it is just a normalization process, Josh.
All right, thank you, Julie. Appreciate it. Taking a look at shares of NVIDIA rising in after-hours trading here. A company announcing an expanded partnership with Accenture to get more of the consultants' clients to use AI technology. As part of the statement, Accenture has trained 30,000 experts on the use of NVIDIA's technology. And in an interview on CNBC, NVIDIA CEO Jensen Huang also weighing in on demand for its Blackwell chips, calling it insane. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.